This is really important discussion. Thomas Costerg joins us with Pictet right now, Pictet Wealth Management. And Thomas, you got buried in your note a really, really, really important sentence. You ignore consumer surveys. Why?
I do, and I think it was the right thing to do because we've seen retail sales data that actually the U.S. consumer is fine. And I actually look at credit card data, and I see that U.S. consumer is fine, is happy to go and spend and take more credit. So I'm a bit more dismissive of recent consumer surveys. I think they're maybe affected by the end of the jobless benefits. But otherwise, I think the U.S. consumer is fine. And I think we have some data today showing that, the U.S. consumer is fine and can withstand so many headwinds like Delta, like the end of QE and so on and so forth.
It's a tidy number. It's a strong beat. Hesitant to move on from retail sales too quickly. But Thomas, just your view on the business surveys we get from the regional Feds. We had the Empire Manufacturing Survey out earlier this week. That was really nice too. The Philly Fed Business Outlook right now, that's a big upside surprise. This is for September. What's the early September data telling you, Thomas?
Well, if you look at the NFIB survey, the Empire survey, I think they're actually much better than expected. So, the order books are actually looking fine. Maybe actually too fine, because the risk maybe in 2022 is that we have so many orders that actually there's a risk of having some fake orders as companies order too much and maybe they cancel orders down the line. But I think so far we're still in the early phase of this accelerating business cycle, and things are fine. There are some bottlenecks, I must say, some bottlenecks affecting cars, for instance, but they are very niche products. Otherwise, the U.S. consumer is fine. U.S. manufacturing chains are okay, more or less, given the supply chain bottlenecks. But otherwise, the order books look fine. So I'm actually quite positive on U.S. growth, especially in the fourth quarter.
Take that positivity then and push it forward to the 22nd, the Fed decision. How does this all fold in to that?
Well, so the Fed has already well telegraphed that they intend to taper before the end of the year. I think they won't do it next week because, first of all, I think Jerome Powell does not want to rock the boat. He's seeking renomination, so he doesn't want to rock the boat and move financial markets too much. So he's going to probably wait until November. But otherwise, I think, the pressure is there for them to taper, given this, strong data and also ongoing strong inflation. I think the regional Fed presidents are going to want to push towards a firmer schedule on tapering, and maybe actually they're going to put hawkish dots in there.
Thomas, are you saying that even if the data supports the idea of tapering their bond purchases earlier, that Fed Chair Jay Powell would not do so in order to curry favor politically?
Well, what I'm going to say is that the Fed is like a super tanker, and you don't change direction so quickly. They've indicated they want to do it before year end. I think they are going to stick to that view, and I don't see any sign of rush coming from Jerome Powell. So, I think he's going to indicate that it's coming soon, but I think they are unlikely to do it next week. Also, we have some deadlines in D.C. as well.
That's interesting.
It's not the only one saying it.
I know, but it's interesting to me. And the whole idea is, to me, frankly, John, is the data actually backing a taper that they're not going to do because of other motivations?
Some people are asking that question.
Yeah, I think it's out there. It's part of the mix of the data and the huge variance we see here in opinions. Tom Costerg, the last time I fell off my seat before today was at the Zurich McDonald's when I figured out, this is right down from Bahnhofstrasse, where Pictet has their wonderful office, over the price of a cheeseburger in Zurich. This morning I fell off my chair because you're talking about a Volcker moment. You got to be kidding me that we're going to see a Volcker moment at a 3 or 4% inflation rate. Really?
Well, I'm highlighting this as a risk because I think the baseline is that the Fed will ignore high inflation. And when I say high inflation, it's 2 to 3% inflation. However, the problem may come if inflation comes at 4% next year.
Are you kidding
and then
me?
There will
4%,
be a risk
we're going to panic.
I mean, it's quite unlikely, but it's not impossible, right?